Admission of a partner. See, these are the important adjustments. While admitting a new partner, the following adjustments are necessary. In the previous video, we have already discussed the first two adjustments. The first one is recording the capital of a new partner, and the second one, calculation of new profit sharing ratio and sacrificing ratio. In this video, we are going to see the remaining adjustments along with the problem. So the first one is revaluation of assets and liabilities. Next, transfer of undistributed profit or losses, and third one, transfer of accumulated reserves, and the last one, treatment of goodwill. So now we are going to see the first one, that is revaluation of assets and liabilities. Revaluation of assets and liabilities. See, at the time of admitting a new partner, the existing partner need to revise or revalue their assets and liabilities. It's called revaluation of assets and liabilities. So when they revise the value of their assets and liabilities, there is a possibility of increasing the value of assets and decreasing the value of assets. At the same time, there is a possibility of increasing the value of liabilities and decreasing the value of liabilities. All these items are classified into two categories. First one is profit items and second one is loss items. So now I am going to explain the profit items. So the first one is increase in the value of asset. Okay, at the time of revising or revaluing the asset, if the asset value is increased, it will lead to gain for the partner, that is profit item. Okay, at the same time, decrease in the amount of liabilities. So when the liability decrease, it will also have a same effect. When the asset increase, it's a gain. When liability decrease, is also gain. And any unrecorded assets now recording in the books of accounts. So this is also gain for the partner. So these are the profit items. First one is increase in the value of assets and unrecorded assets now recording, and decrease in the amount of liabilities. So these are the items which will lead to increase gain for the partner. So entry for the transaction is concern asset account data, concern liabilities account data to revaluation. So asset always showing debit balance. So when the value of asset increase, again debit. So write concern asset account data, decrease in the amount of liabilities. So liabilities always showing credit balance, but when the liability decreases, enter in debit side, that is opposite side. So concern liabilities account data to revaluation. For unrecorded assets now recording, so enter debit side. So concern asset account data, concern liabilities account data to revaluation. This is the entry for profit items. Now see the loss items. So loss items are, the first one, decrease in the value of asset. So I told you, asset is always debit balance. When the asset value decrease, it's a loss. Okay. So when the asset value decrease, enter credit side. So asset always showing debit balance. When the asset value decrease, just enter opposite side, that is credit side, to concern asset account. Okay. Increase in the amount of liabilities. So liabilities always showing credit balance. When the liability increase, again credit. So concern liability account. Okay, third one, unrecorded liabilities recorded. Certain liabilities are not recorded in the previous balance sheet. Now they have found and now they are going to enter in the new balance sheet. So it's a loss for the partner. So it will be credited. So to concern liabilities, and the new liability created, this is also loss item. Okay, so all these loss items will be credited. Entry for the transaction is revaluation account data to concern asset account to concern liabilities account. When the asset value decrease, credit. When liability value increase, credit. When new liability created, credit. When unrecorded liabilities recorded, credit. Okay, so this is the entry for loss items. After making the journal entry, the next step is we need to prepare revaluation account. So look at the format: revaluation account, debit side, credit side. Okay, so all the profit items will be recorded under credit side of revaluation account, and all the loss items will be recorded under debit side of revaluation account. Let us see the entries. Look at the profit items. So increase in the value of asset. So if any asset increase, it is a gain for the partner. No. So this will be recorded under credit side of revaluation account. By asset, you have to write each and every asset separately. So when any asset increase in the value of asset, that will be recorded separately under credit side of revaluation account. So increase in the value of asset. Unrecorded assets recorded. So if there is any asset which is not shown in the balance sheet, now they are going to record. So it is also gain. So this will be recorded under credit side of revaluation account. By asset, that is any unrecorded asset, you have to write credit side of revaluation account. Decrease in the amount of liability. So any liability, the value of liability decrease, it is a gain for the partnership firm. So this is also will be written under credit side of revaluation account. Look at the revaluation account credit side. By liabilities, decrease in the amount. So all profit items will be recorded under credit side. Now look at the loss items. For loss items, decrease in the value of asset. So any asset decreases, it is a loss for the partnership firm. So this will be recorded under debit side of revaluation account. Look at the revaluation account debit side. To asset, decrease in the value of asset. So any value of asset increase, credit side, decrease the value of asset, debit side. So to asset. So you have to write separately for each and every decrease the value of asset will be shown separately, that is individually. So decreasing in the value of asset, debit side of revaluation account. Next one, increase in the amount of liability. So any liability value increases, it is a loss. This is also will be shown under debit side of revaluation account. Look at the revaluation account debit side. To liabilities, that is increase in the amount of liability. Third one, unrecorded liabilities recorded. If there is any liability which is not recorded in the old balance sheet, now they are going to record. So it is a loss for the partnership firm. This is also will be shown under debit side of revaluation account. To liabilities, that is unrecorded liability, now they are recording. Then the last one, new liability created. Okay, so there is no liability in the previous balance sheet. Now they have found a new liability, or the new liability is created, that will be recorded under debit side of revaluation account. To liability, that is newly created liability. For each and every liability, when liability value increases, you have to write separately. When unrecorded liability, now they are recording, that is also will be written under debit side separately. And if there is any new liability created, that will also be shown under debit side of revaluation account separately. So these are the loss items. After entering all these things, you will be getting either profit on revaluation or loss on revaluation. If you get any balancing figure under debit side of revaluation account, it is a profit. If you get any balancing figure under credit side of revaluation account, it is a loss, that is loss on revaluation. Whether it is a profit on revaluation or loss on revaluation, whatever it is, this amount will be transferred to partners capital account, that is old partners capital account, according to their old profit sharing ratio. Entry for profit on revaluation is revaluation account data to old partners capital account. Entry for loss on revaluation is old partners capital account data to revaluation. See, to transfer profit or loss on revaluation, if you get any profit, entry is revaluation account data to old partners capital account. In case of loss, entry is old partners capital account data to revaluation. Look at the adjustment. Third adjustment is over. Now we are going to see fourth adjustment. That is transfer of undistributed profit or losses. Okay. See, at the time of admitting a new partner, see the old balance sheet. If you find any profit or loss under liability side, it is a profit. Okay. If you find any profit or loss under asset side, profit and loss account, so it is a loss. So in case of profit, it will be recorded under liability side. In case of loss, it will be shown under asset side. So this is called as undistributed profit, and this one is undistributed loss. See, whether it is an undistributed profit or undistributed loss, this amount is wholly belong to old partner's capital account. So this will be transferred to old partner's capital account according to their old profit sharing ratio. Okay, before you admitting or at the time of admitting a new partner, okay, if you find any undistributed profit or undistributed loss, this will be transferred to old partner's capital account. So entry for the transaction is, look at the journal entry for transfer of undistributed profit. So this you can find under liability side. Okay, if you find any undistributed profit, this will be transferred to old partner's capital account. Entry profit and loss account data to old partner's capital account. So according to their old profit sharing ratio. So this will be transferred to old partner's capital account. In case of loss, just opposite entry. For transfer of undistributed loss. So this you can find under asset side. So entry is old partner's capital account data to profit and loss account. So this will be transferred to old partner's capital account according to their old profit sharing ratio. For profit and loss account data to old partner's capital account. For loss, old partner's capital account data to profit and loss account. Look at the adjustments. So far we have discussed revaluation of assets and liabilities, transfer of undistributed profit or loss. So now we are going to see the next adjustment, that is transfer of accumulated reserves. Transfer of accumulated reserve. Okay, see, generally in a partnership firm, every year out of profit, they'll make some portion as reserve. Okay, they'll maintain some reserve for future or unexpected loss, to meet some unexpected loss. For that purpose, they'll maintain some reserve. Okay, this is called as accumulated reserve. For example, general reserve, contingency reserve, or any other reserve fund is called accumulated reserve. So this is a portion of profit which they have accumulated to meet the unexpected future loss. At the time of admitting a new partner, if you find any reserves, you can find all reserves under liability side. So if you find any reserves in the form of reserve fund or general reserve or contingency reserves or any other reserve, all these reserves or belongs to old partner. So all these items will be transferred to old partner's capital account according to their old profit sharing ratio. For transfer of accumulated reserve, entry for the transaction is reserve fund account data to old partner's capital account. So in case of general reserve account data to old partner's capital account. In case of any other reserve, for example contingency reserve, so contingency reserve account data to old partner's capital account. So this is the entry for transfer of accumulated reserves to old partner's capital account. Look at the last adjustment, treatment of goodwill. Goodwill means it's an intangible asset. It is a effort of the old partners for their past. Okay, so at the time of entering a new partner, you have to give a necessary treatment for goodwill. See, for goodwill treatment, there are different methods are available. Here we are going to see only revaluation method. So according to revaluation method, The new partner need not bring any cash for his share of goodwill. See, goodwill, it's a reputation or hard work or effort earned by the old partner, that is existing partner. Okay, at the time of entering a new partner, the new partner need not bring any cash for his share of goodwill according to revaluation method. But instead of that, they can raise the goodwill value in their books of accounts. Okay, so under revaluation method, there are three different scenarios are there. The first one is goodwill is raised in the books of the firm. Okay, so already in their books of accounts, that is in the old balance sheet, there will be no value of goodwill. Now they are going to raise goodwill in the books of the firm. So in such case, entry for the transaction is goodwill account data to old partners capital account. So this amount will be transferred to old partners capital account according to their old profit sharing ratio. So in their balance sheet, you cannot find any goodwill value. Now they are revised. Now they are raised goodwill. So the entire amount will be transferred to old partners capital account. Entry for the transaction is goodwill account data to old partners capital account. Second scenario, goodwill appears in the books understated. So now they are raising the goodwill value. No, already they have showing some amount as goodwill under asset side, but that amount is understated when compared to the revised value of goodwill. The old value, that is the balance sheet value, is understated. In such case, just find the difference between the revised value, that is a revalue of goodwill, which is shown under adjustment, and compare with the existing value which is shown under asset side. The difference will be transferred to old partners capital account. So in case of understated, so understated means the revised value is more than the book value. So in their old balance sheet, they are showing lesser value than the revised value, is called understated. The last scenario is goodwill appears in the books overstated. That is the same thing. In their old balance sheet, goodwill amount is given under asset side, but that amount is overstated. So in the revised value of goodwill is lesser than the balance sheet value. So this is called as overstated. So in such case, just compare balance sheet value with revised value. Okay, just find the difference. The difference will be transferred to old partners capital account. Entry is just opposite entry. Old partners capital account data to goodwill account. Why? Because here in the balance sheet they are overstated. They entered excess amount than the revised value. So this is called as overstated. For understated, goodwill account data to partners capital account. For overstated, partners capital account data to goodwill. Just opposite entry. So these are the three different cases in the treatment of goodwill according to revaluation method. Look at this example problem. A and B are partners sharing profits in the ratio of 3:2. They decided to admit C for 1/5 share of future profit. Goodwill of the firm is to be valued at 1 lakh. See, this is the revised value of goodwill. Okay, that is revalue of goodwill. Give journal entries if three scenarios are there. They are asking you to make journal entry if in case of there is no goodwill in the books of the firm. Okay, in their old balance sheet there is no goodwill. So now they are raised up to 1 lakh. So entry for the transaction is goodwill account data to old partners capital account. Goodwill account data to A's capital and B's capital. A's capital account and to B's capital account. Okay, in their old balance sheet there is no goodwill. Now the goodwill is raised how much? 1 lakh. So enter 1 lakh. What is the profit sharing ratio? Their old profit sharing ratio is 3:2. So the 1 lakh is transferred to A and B according to their ratio. For A, 3 by 5. For B, 2 by 5. Okay, so 1 lakh into 3 by 5 is equal to 60,000. 1 lakh into 2 by 5 is equal to 40,000. For A, 60,000. For B, 40,000 according to their old profit sharing ratio. Narration. Goodwill raised to its present value, that is 1 lakh, and credited in the old partner's capital account. So according to their profit sharing ratio, that is old profit sharing ratio, they have transferred. Look at the second case. The goodwill appears at 60,000. That is, in their old balance sheet, already goodwill appears at 60,000. Now look at the revised value. The revised value is 1 lakh, which means understated. The balance sheet value is lesser than the revised value. So in this case, you have to find the difference. The difference amount will be transferred to old partner's capital account according to their old profit sharing ratio. So what is the difference between 1 lakh and 60,000? 40,000. Goodwill account data to A's capital and B's capital account. A's capital account to B's capital account. So here you have to write the difference. So understated, no, how much value is understated? 40,000. So this will be transferred to A's capital and B's capital according to their profit sharing ratio. Their old profit sharing ratio is 3:2. For A, 40,000 into 3 by 5. For B, 40,000 into 2 by 5. For A, 24,000. For B, 16,000. 24 and 16. Narration. Increase in the value of goodwill transferred to partners' capital accounts in their old profit sharing ratio. Look at the third case. The goodwill appears at 1,20,000. See, in their old balance sheet, already goodwill is there. It appears at 1,20,000. Now see the revised value. The revised value of goodwill is 1 lakh. Okay, so what is the difference? 20,000 overstated. The previous one is understated and third one is overstated. So 20,000 rupees overstated. So this will be transferred to old partner's capital account, but the reverse entry. Entry for the transaction is old partner's capital account data to goodwill account. So two partners are there, no? A's capital account data, B's capital account data to goodwill. Old partner's capital account data to goodwill account. Here you have to write the difference, that is 20,000. This will be transferred to A's capital and B's capital according to their old profit sharing ratio. For A, 20,000 into 3 by 5. For B, 20,000 into 2 by 5. For A, 12,000. For B, 8,000. For A, 12,000. For B, 8,000. Narration. Decrease in the value of goodwill transferred to old partners in their old profit sharing ratio. Look at the adjustment. So at the time of admitting a new partner, these are the necessary adjustments. So in the previous video, we have already discussed first one and second one. In this video, we have discussed 3, 4, 5 and 6. Hope you all understood this concept. Thank you.